Royalties are ordinary income, treated as being earned from the underlying property as opposed to the disposal of that property. Ted is an explorer who wrote his memoirs and retains copyright. He granted publishing rights to a company in exchange for payment of $1 from the sale of each book by the publisher. The payments are not related to the rendering of services or carrying on a business. Consequently, they are not ordinary income for Ted from these sources. But the payments are a royalty within the ordinary meaning. This is because they relate to Ted's intellectual property, and the amount paid depends upon the quantity actually exploited. The common law royalty characteristics are payment for the right to exercise a privilege or right. Payment is to the owner of that right, and the amount paid is determined by the quantity of the right actually used. It is possible to structure the legal form of certain transactions as an outright sale of an asset combined with the grant of a separate right to remove the asset. This is no longer income flowing from the use of the property in the ordinary sense, but rather a payment for the disposal of a capital asset. However, where the price paid is referable to the quantity taken or utilised, then for the purpose of section 15-20, this is treated as an amount received as or by way of royalty. This includes amounts that would otherwise have been treated as capital receipts, for example, the disposal of a capital asset. There are two examples from the case law that demonstrate this principle. The first is the case of Macaulay and the FCT. In this case, a dairy farmer owned land with standing trees. The farmer sold the trees to a logger. He also sold the right to enter, cut and remove trees for a price determined by the quantity removed. The farmer did not purchase the land for the purpose of growing timber. Therefore, the payments were not ordinary income from a business of selling timber. Chief Justice Latham deemed that the price was related to the outright sale of the trees and was not a royalty within the ordinary meaning. This sale related to disposal of a capital asset. However, it was decided that the payments were assessable under Section 26F, which is now Section 15-20 of the ITAA 97, as an amount received as or by way of royalty. This was because the price was determined by the quantity cut and removed. Another example from the case law, but where income was not deemed to be royalties, was in Stanton and the FCT. In this case, a grazier owned land with standing trees. He sold the trees and the right to enter, cut and remove timber to a sawmiller for a fixed price, regardless of whether the timber had been removed. The grazier did not purchase the land for the purpose of growing timber, so the payments were not ordinary income from a business of selling timber. And again, the price was related to the outright sale of the trees and is not a royalty within the ordinary meaning. But this sale also related to disposal of a capital asset. However, in this case, the payments were not assessable under Section 26F because the price did not reflect the quantity or value of timber actually removed.